This program was made possible by the law firm of Zalman and Schnorman, whose practice is limited to personal injury and insurance law. Welcome to Lawline with your host, Alan Schnorman. Mr. Schnorman is a distinguished trial attorney, author, and lecturer. Each week, Lawline will bring you the most knowledgeable experts in the field of law today. And now, we introduce our guests and our host, Alan Schnorman.
Welcome to Lawline. If you've been putting off writing a will or speaking to an estate planner, then this is a show you should see. Today we'll speak to Gideon Rothschild, a wills and estate attorney, and Joseph Falanga, a CPA and estate planner, and find out what you can do to minimize your taxes. Hello, Gideon. Hello, Joe. Gideon, who needs a will and why do we need wills?
Everybody needs a will, Alan. If you don't have a will, you actually do have a will, even though you might not realize it. The state gives you a will. And if you don't have a will, a written will, then the state's will provide that your assets will go in accordance with the law.
Well, I assume if I don't have a will and I die, my money goes to my wife. It goes there anyway.
Maybe not. Depending on the state you live in, for example, in New York, it may not all go to your wife. Maybe if you have children, it's going to wind up going half to your wife and half to your children. And if you have minor children, that half is going to be locked up until those children reach age of majority.
So where do I go? How do I get a will?
Well, you have to, you could, if you really have a simple estate these days, you have these computer programs out today that people can use and prepare a will. But I would recommend that unless your estate is of the most simple variety, you not rely on these computer programs, because a lot can go wrong because people not just don't draft their wills properly, but they might not execute it properly. A will has to be executed with the proper formalities.
Joe, I know your clients pay you thousands of dollars for your advice to save them money on estate planning.
But okay.
Give us something. How everybody wants to save money. Everybody wants to pay as little taxes as possible under the law. How do we do that in estate planning?
Well, there's many ways to do that, but one of the basic approaches is to take your assets and sort of try to equalize them between the husband and wife. And in a lot of cases, in those estates that are rather small, certainly taking advantage of the unified credit, the $600,000 that each
Tell me what that is. Explain.
Okay, let me explain to you that. Each individual during their lifetimes as well as at death is allowed to give away up to $600,000. At that point, anything above that amount is subject to taxation, unless you're
federal taxation.
Federal taxation, right. Of course, under New York rules, you're allowed up to $125,000. And then, as we go to tape with this show, New York is even considering getting rid of the estate tax rules.
Like Florida and some other states.
Absolutely. Well,
if you die in Florida, there is no estate tax. Isn't that right?
Correct.
Well, that's really kind of a fallacy, because there is an estate tax in Florida.
But they don't call it that.
But they call it an estate tax, but if you didn't have an estate tax paid to Florida, your federal tax would be higher because you get a credit for whatever you pay the state.
Now
so it's 6 of one, a half a dozen the other is what I'm saying. Either you're paying the federal the full share, or you're paying a combination to the state and the federal government, a combined amount equal to that.
So are you saying by moving to Florida, you're not saving on your total estate taxes?
You are, only because New York has a tax that you don't get full credit for.
Okay.
And so you're paying a higher tax to New York, and what Joe mentioned is New York wants to eliminate that extra layer of tax that they would get now.
So tell us, how do we save on taxes?
Well, certainly getting back annually, a person should always consider making gifts at least of up to $10,000 if they can.
Per child, per individual?
Per individual.
Can I make, if I have 5 children, can I give each $10,000 without limit?
And husband and wife can do $20,000 together, because the $10,000 applies per person, a donor to donee.
Am I only limited to relatives, or can I give other people?
You can give to anybody you want, as long as it's limited to $10,000 a year. There's no limit, and often there's
per individual.
Per individual.
So I can give out $100,000 a year, or anything that number, and when I pass away, there'll be no estate tax.
That's correct, and there's no gift tax. And a lot of times people think that if they get a gift, they have to report it somewhere, and it's going to be taxable to them. It's a common misconception. People confuse the income tax system from the gift tax system. Receiving a gift doesn't create any income to you, nor does it create a deduction for me on my income taxes. It's simply, if it's within the $10,000 annual limit per person, per donee, the person that's receiving the gift, there's absolutely no reporting to do whatsoever by anyone.
If someone gives a gift greater than $10,000,
Then you have to file a gift tax return. And the person that has to file a gift tax return is the donor. The person that's making the gift has to file a gift tax return. And slowly, the amount of these gifts in excess of $10,000 will be aggregated. So if you make a gift this year of $100,000, you reduce it by the $10,000 you're allowed to make a gift of, so it gives you a net gift of $90. Then next year you make another gift of $100. Well, you again reduce it by 10 if it's to one person, and you have another gift of $90. Now you add those two up and you got $180. What you've done is you've used up part of your $600,000 allowance.
But of course, that's to only individuals, and not talking to charities or anything of that nature.
That's right.
Keep in mind one thing also, Alan, is the fact that an individual can pay, or a parent can pay for the tuition cost or the medical expenses of their children. And that is fully exempt. That can go into...
Not just parents, anybody.
Right.
And this is wonderful for grandparents. If you're
So
a grandparent out
grandparents
there,
can-
you can write out a check to your kids. Your kid goes to private school, let's say, and it costs $15,000 a year. In addition to the $10,000 you can give to your grandchild, you can make an additional payment of $15,000.
Do I have to
as long as it's to the school.
In other words,
Got
the
it?
check has to be to Sarah Lawrence
That's
College.
right. That's right.
So that's interesting. So if you really want to dissipate your estate because you don't want to pay the government state taxes, let's talk
It's
about
not
how
paying
much...
them, it's sharing with the government.
I understand.
fortunes.
Let's talk about how large or small
I don't
are
think
these...
too many people want to share
Gideon,
it.
How large or small are these estate taxes? How high can they get?
The estate tax, in fact, people spend a lot of time trying to reduce their income taxes. The income taxes, by comparison, are low. Estate taxes start out at 37% at the lowest level, which is $600,000. You reach 49% very quickly at $2 million. And at $3 million, you reach 55%.
So let me ask, if I have
quite a
life
bit.
insurance, if I have $500,000 worth of life insurance, does that come into play as far as my estate taxes are concerned?
Absolutely, and that's also a common misconception. People think life insurance is not taxable. Life insurance isn't taxable for income tax purposes, again. You don't report income tax on it, but life insurance proceeds will be part of your estate. So if you die and you left an insurance policy and the beneficiary is your children, then they will receive the money, and it will be subject to as much as a 55% estate tax on that insurance. Now, of course, if you leave it to your wife, and your wife gets the proceeds, there's no tax because you have what's known as a marital deduction. Anything, you could leave as much as you want to your wife. You could leave her $10 million. Look at Leona Helmsley. Mr. Helmsley left her almost $2 billion. A
lot of money.
And his estate will not pay a dime. And the reason for that is because you could leave an unlimited amount to your spouse. But what happens when your spouse dies? That's when the tax will eventually kick in. And if your spouse receives your life insurance proceeds and doesn't dissipate it during her lifetime, then at her death, those proceeds will be subject to estate
Joe,
tax.
is there a way to stave on estate taxes by creating trusts?
Yes, especially in
How do you do that?
just the situation that Gideon spoke about. A way to avoid taxation on the insurance is by creating an insurance trust where the insurance is payable to the trustee, and then the trust itself then disseminates the proceeds among your beneficiaries in accordance to
So
your
let's
will.
take that. That's an important point. Let's take that slowly. When I take out my $1 million life insurance
Sure.
or $100,000 life insurance, instead of having the proceeds payable to an individual, I have the proceeds payable
Well,
to a life insurance trust.
Plus, the life insurance trust must own the policy.
Okay.
That's where, so
But my broker, I'm sure, or my insurance broker can probably do this for me.
No, you need to go to an attorney. You need to
Okay.
draft an insurance trust and have the policy owned by the trust. It becomes an asset of the trust. And the trust is a legal instrument that has to be
So
drawn by an
then
attorney.
all the monies received when I pass away as a result of life insurance is not taxable.
That's correct.
That sounds like a great tax
It's
dodge.
the biggest loophole around. It's because the insurance lobby is so strong. But the IRS is looking at that very carefully these days. So you need to know that there may be some limitations on that in the
Now, the
future.
thing is, well, let's get into that, because when we talk about it as a loophole, it's really a leverage type of gift. Because in a sense, when a person is paying the premiums on those life insurance policies, they're making a gift of the premium to, in a sense, indirectly to the beneficiary.
Right.
So in a sense, every year you have to file a gift tax return for the premiums you pay in most cases. And then you're leveraging the premiums paid then against what you'll eventually receive, or what will eventually be received by the trust. And that should be usually more
So
than
in
what
other
the
words,
premiums
every
are.
year, if you're paying over and above $20,000 in premiums,
Right.
you have to file a gift
Well,
tax?
not necessarily. It gets a little bit more complicated than that. You're allowed $10,000 annual exclusion, or if you're married, you're allowed $20,000, as you say. But what if you have 4 children?
Right.
Now you have $80,000. So your premiums could really be $80,000 before you have to file a gift tax return, before you have
What
to
happens
pay
if
the
you
gift
fail to
tax.
file this gift tax return?
Well, it generally accumulates. Sooner or later, someone will advise you to file a gift tax return, because it is an accumulation process, just like we started to say in the show, that as you make gifts each year, you accumulate upon the prior year's gift. So if you don't do gift tax returns, sooner or later it'll come to bear.
Without getting too complicated, let's assume that a person is using this not only for life insurance, but as a saving vehicle with life insurance as part of it. And they're overfunding it, meaning they're paying more than just the cost of insurance every single year. And even after the life insurance is paid up in 10 years, they keep making the payments. Again, are all those proceeds tax-free as far as estate tax purposes?
Sure are. And they go, well, in a sense, they're tax-free because eventually the growth and the income that has been accruing on those assets would go to the beneficiaries at some point, and generally the gift is only that amount which was originally placed into the trust by the parent.
Gideon, let's talk about generation skipping.
Okay.
What is that?
Very important. Generation skipping is a way to reduce a layer of estate tax at the next generation's level. Very simply, if you're very wealthy and you have $10 million, well, why not, you could use a loophole up until recently, which allowed you to set up a trust under your will, leaving everything for the benefit of your children and grandchildren. When your children died, even though when you died, you had to pay estate taxes at your estate death,
Right.
your death. When your children died, they didn't have to pay any estate taxes when that money eventually went to their children.
Right.
And the reason for that is because your children didn't control it. They were merely beneficiaries of the trust. Well, the government thought that that was too cute. It allowed wealthy individuals to pass down tens of millions of dollars beyond one
That's why the rich
generation.
get richer.
That's right. And so what they did now is they said, well, the most that you can pass and skip a generation by is $1 million per individual. So if you could leave $1 million to your grandchildren, either outright or in the form of a trust for their benefit. But if you leave more than $1 million, then not only will it be subject to estate tax, which your estate will pay, but it will also be subject to a 55% from the first dollar, a 55% generation skipping tax on every dollar that that grandchild receives in excess of the first $1 million.
That's unbelievable.
Right.
So there's really a
So they're really,
disincentive then.
they're creating a layer of individuals. Let's assume the person leaves the money directly to the grandchild.
That's right.
Never hits the children.
That's right.
And they're taxed anyway over and
Anything
above $1
over
million per
because what they're
child.
saying is that had the person left the money to their children, when their children die,
There's an assumption.
there's another estate tax that the government's going to get. And by skipping over that child and jipping the
new law?
government out of the tax, it's not that new. It's been around for about 10 years now.
Right. So anybody with really large sums of money must have an accountant and a lawyer.
That's right.
Go over
There
this.
are a lot of things you can do to avoid the generation skipping tax, to avoid the estate tax. Joe and I do a lot of work in the area of family partnerships, for example.
So let's talk about
qualified
family partner.
residence.
Now that's something only in the last 2
That's
years.
a very hot area.
What's a family partnership? We'll find that out. We have to go to a break now, but right after the break we'll cover that. You're watching Lawline. We're talking how to save you taxes. Stay with us.
Why would anybody give someone they don't know gift. They do it because this gift saves lives. And the need for it is desperate. We need over 20,000 people to give this precious gift every day. Please give blood. There's a life to be saved right now. Call the American Red Cross at 1-800-GIVE-LIFE.
Hello, you're watching Lawline. Today we're trying to save you taxes as far as estate taxes. Our guests are Gideon Rothschild, wills and estate lawyer, and Joe Falanga, a CPA and estate planner. I wanted to pronounce that right, the name absolutely correct. Now we were talking about family partnerships. Gideon, what is it?
A family partnership is a legal entity formed under state law. And think of it as a family business, a family, just like a corporation would be. It's a partnership. But the distinction here is that there's a limited partner or more than one limited partner, and there's general partners. The general partners
We're talking about a family now. My wife, myself, my children, right?
Exactly. Let's say
I'm limited partners.
You and your wife are going to be the general partners of this partnership,
Right.
which means what? The general partners control all the shots.
I like
you
that.
have voting control over everything.
I like
okay?
it better.
Your kids don't control a thing.
They don't listen to us anyway.
Exactly. So why do they need to control anything? The beauty is that regardless of whether your kids are 5 years old or 40 years old, you're going to be the one in control as to the family's assets and investments in this partnership.
Right.
So take a very simple example. You've got $1 million, and instead of giving $10,000 a year to each of your children and giving them control, they can do what they want. A lot of parents fear the possibility, well, what happens when my kid turns 18
They'll
and
marry
they can run
somebody
off
who
with the
won't like
money
us.
and they don't want to go to college. Instead, they want to join a Michigan militia or something, and they said, Dad, you know that money in that bank account that's grown to $200,000 because you've been putting in $10,000 a year for the last 18 years? I want that money, and you can't stop me from getting to it. Because, of course, they've reached the age of majority. And even though you had a custodian account,
At
you lose
21
control.
at 21
That's it.
you lose control.
21, you lose control. Now, how do you avoid that? Well, one way of avoiding it is by opening up a partnership account with your bank, with your brokerage house, and instead of every year giving your children $10,000 into a custodian account that they can do what they want with later on, the $10,000 goes into the partnership. Each child is a partner of this partnership, together with the two of you, with you and your wife. And depending on what percentage interest the child has, if you put $1 million in there, and every year you give a child 1% of the pie, so that the first year you're giving them a gift of 1%, which is $10,000. Second year you give them another gift of 1%, another $10,000, and so on. After 15 years, maybe they might own 15%. But that 15% interest does not give them any rights whatsoever.
Of control.
They don't have the right to ask you for distributions. They don't have the right to ask you for the income or the principal or to liquidate their partnership interest. They are totally at your mercy. And if you want to make distributions to them, then great. And if you don't,
Now,
then
Alan, there's
that's
another benefit here, and that is when you have this limited partnership and you wanted to give your annual gifts of $10,000, in a sense, you might say, okay, I have this partnership funded with $100,000, so I want to give them each $10,000. Well, in a sense, would you pay me for 10% interest in a partnership, $10,000 in a $100,000 partnership? Not really, because why? If I control that partnership,
Right, no control. I'd be a minority stockholder.
you're a minority holder. I control any income you
Got
would
it.
get, and therefore I would be, if I was making a gift to you of that little minority interest, entitled to a discount because someone outside would never pay you full fair market value to have
So
a piece
you're
of
saying,
it.
keep going.
There's a valuation discount. in
As
there.
far as when I die.
No, when you make the
when you're
gift.
making
When I
the
give-
gifts.
So I can actually give more?
That's
So,
right.
in a sense,
Because of the value, I can give more than 10,000 or
Right,
1%
right.
because of the valuation
Right.
discount of a minority interest, which is worth
Right,
less, even though it's 1%.
so we'll
Very
say,
good.
since I'm an
I
accountant,
went to law school. Question, Gideon, I have a question. Now, I've given cash, that's easy. What if I want to, I have investment real estate?
Well, here's where it's really great. Where you have real estate, it works like a charm. When you have cash, when you have marketable securities, what Joe was talking about with this discount, the IRS might not be too keen on giving you a discount for that. But where you have real estate, Court cases have already decided over many years that you're entitled to this discount. What makes it very useful to use a partnership is if I wanted to give a gift of a piece of that real estate to my child every year, I'd have to record a new deed every year to show a sliver that child owns as a tenancy in common. But instead, as a partnership, I only have to assign them a 1% or 2% interest or what have you. Each year, it's one sheet of paper, it doesn't get recorded anywhere, and it converts that real estate holding into what's known as an intangible. And what also a big advantage of this is let's say you have out-of-state real estate.
Right.
Where we use this to a great extent is in those situations where you might have a family vacation home, or you might have income-producing property in another state, New Jersey, Pennsylvania, Florida. Well, when you die, there's going to have to be a probate proceeding in each one of the states that you own real property. But if instead of owning real property, you have a partnership that owns the property, and you only own the partnership interests in that partnership, then there's no property owned in other states.
Because there's no death.
And there's no death of the partnership.
Right.
And so you avoid all the ancillary probate proceedings, you avoid having to hire an attorney in all those other states, and all you do is do the probate in your state.
Let's assume today I put in real estate into this family partnership, and that I don't pass away hopefully for another 30 some odd years or more, and the real estate has appreciated during these 30 years.
Well, that appreciation would belong to the partners in their proportionate share. So if your children own 10%...
At today's value.
At today's value. In 30 years, they still own 10% of whatever the value is at that time. Exactly.
So in other words, another way of saving on taxes.
That's correct, because you're getting the future appreciation out of your estate when you're making these gifts.
Well, under that, why shouldn't everybody who wants to leave money to their children form family partnerships?
Many people are. We've been quite busy in the last few years doing this.
There's a certain amount of administrative work. Certainly, you have to set up the agreement.
Do you have to file tax returns every year?
Partnership return every year, so you've got to go to your accountant to do that.
Family...
Well, the partnership return has to be completed, filed, and then that has to then be incorporated into your own individual income tax return.
And then the children would have to pay income tax on their percentage of income from the partnership, even though they don't get it.
Also, as you
Interesting.
and also as you make gifts, if you do it on an annual basis, you probably need to have a revaluation done for each piece that you
This is
give.
good. So we have 1, life insurance trust. 2, family partnership. What's another way to
How about a
save money?
residence trust? You own a home. You own your co-op here in the city.
Right.
It's worth $500,000. It might be the most expensive, the most valuable asset you own.
Right.
What could we do with this? We don't want to give it up really right now. We want to continue to live in it for a while. You're maybe 55 years old. Well, how about something called a personal residence trust, where you can take that home, contribute it into a trust for a period of time. It might be 10 years, it might be 20 years. Let's say you did it for 15 years. So you're 55. When you're 70 years old, the trust will end. During these 15 years, you live in this house. You could sell it if you want to sell it, buy something else in exchange. You don't lose any of the tax benefits. You deduct the mortgage interest. There's absolutely no restrictions on you during that 15-year period. Once the 15 years are up, your children will own your house. And then you'll start paying them rent if you want to continue to live in it.
They will own it because they're the beneficiaries of the trust.
Because they're the beneficiaries of the trust after the 15 years. Now, here's how it why it works. The reason it works, and the IRS accepts this, is because theoretically, you're not making a gift to them today. You're making a gift to them that takes effect 15 years from now.
Right.
Therefore, the value of that gift is not $500,000, assuming the house is worth $500,000, but rather the gift is worth maybe $200,000 only, because taking into consideration present value
It's a present
concept,
gift of a future value.
Exactly.
Right.
So if it's only worth $200,000, but in 15 years they get whatever's in that trust. If it's a house worth at that time $1 million because it's appreciated in value, they will receive that house without any further gift tax consequences.
Is that, as far as the personal residence, does it only work for personal residence?
It only works for up to, you can use it with 2 residences.
And is that a better way than the family partnerships for residences?
You would never use a partnership for a residence because you would lose all of your tax benefits if you used a partnership for a residence.
Okay, so now that's a third way.
That's correct.
For personal residence, you can do up to 2, putting it into this way. What I want to know is, but however, when you transfer titles, I mean, that you need a lawyer for, that's taking the title out of me and my wife, and let's assume we owe Chemical Bank holds a mortgage on our co-op. or a house.
Sure.
Can I still transfer titles?
You can still do it with a principal residence, especially.
Right.
There's federal law that protects you, that if you transfer it to a grantor trust, there's no problem. You're still going to be personally liable.
Right.
You cannot transfer the house and say, okay, trust, you pay the mortgage. You're still going to be on the hook for the mortgage. Although, by the way, it reduces the leverage you get, the gift tax advantage that you get if you have a house on the if you have a mortgage on the house.
Most people have mortgages on their co-ops and their
Well,
houses.
but a lot of people, when they're into their 60s and they consider doing this, or 70s, they've already paid off.
approaching that.
They already paid off the mortgage, and hopefully by then you will have paid your mortgage off too.
No, mine's going to be with me long after I'm dead.
Well, one thing also, Alan, any year that you do pay some of the mortgage down, in a sense, that would be deemed an additional gift made to the trust. So if you have a mortgage, any amortization that does take place would then be deemed an each year's additional gift to the trust, and would recalculate the tax.
Okay,
gift.
by the way, if you transfer, getting back to that partnership trust, family partnership, if you transfer investment property real estate that has mortgages on it,
Not a problem, but you need to get the lender's consent.
so I need my accountant and I need my lawyer. It's like my left and my right hand.
That's right.
Okay, you gave us 3 very good areas. Is there a 4th?
I'll give you one. Low interest rate loans. Now, here's an interesting approach. This is very simple. It works for a great deal of individuals, especially those that are very savvy in the investment market. Here, if I say, for instance, I want to make a gift to my child, but in a sense I want to give them just the appreciation and still retain the ability to receive back that income or that fund, well, I could make a gift now or a loan to the child with a certain market rate of interest, which would be just as minimal as it possibly can be. Any appreciation over and above that market rate of interest that is charged to the child would then inure to the benefit of the child. In a sense, if I make a loan to my child at 7%, well, if my child is now making 14% on the market,
Right.
well, that 7% differential would go to my child. Of course, I would receive back the interest.
A little complicated.
No, I don't think so. It's probably one of the simplest approaches.
What you're really doing is freezing the value. So if you're making a loan today of $1 million, and your child now takes that $1 million, invests it in the market,
Got it.
converts it to, it grows to $2 million, child only has to pay you back $1 million. You still have $1 million included in your estate, but you have $1 million instead of $2 million now in your estate.
Now I understand.
Your child's got the other $1 million in their hands.
Right.
You've saved taxes on that extra $1 million on your death.
Any other ways?
Well, there's a lot of ways, but I think probably a very important thing to remember is to have a will, number one. Number two, to have a power of attorney that allows a person, in case you become incapacitated, to make these kinds of gifts, to do these transactions so that you can do some planning still, because if you're incompetent, you're not going to be able to do anything on your own. And number three, if all hell breaks loose and you haven't done anything that Joe and I have been talking about today, what can you do then? I had a situation recently
Quickly.
where someone had about $1 million in their estate. Everything was owned jointly. They never went to an attorney. They never accepted anybody's advice to split the assets up evenly. Husband died with $1 million estate, and left everything to his wife because it was all joint.
Right.
The wife was able to disclaim some of that property so that it could go to the children and avoid having to be taxed on $600,000 unnecessarily. And that's called a disclaimer.
Joe, how large of a estate do you need before you hire lawyers and accountants? I mean, what are we talking about?
Well, it's not a matter of largeness, it's a matter of complications in terms of types of assets that
Quickly?
you hold.
Do I need $1 million before I...
No.
If you have more than
less,
600,000, you'd have a lawyer.
More than
You'd have a lawyer
600.
and accountant.
Joe Falango, thank you very much for appearing on Lawline. Gideon Rothschild, thank you once more for coming back to Lawline. And as always, this is Alan Schnorman. Thank you for watching Lawline.
You have been watching Lawline with your host, New York trial attorney Alan Schnorman. Mr. Schnorman will be back with you next week at the same time. If you have any questions about this week's program, please write to Lawline, 63 Wall Street, New York, New York, 10005, or call area code 212-432-9111. This program was made possible by the law firm of Zalman and Schnorman, whose practice is limited to personal injury and insurance law.